Alan sold a rental property and made $300,000. 6 months later, he got a letter from Medicare saying his premiums were going up by $4,000 a year. Then another letter saying more of his Social Security was now taxable. Then he got a bill from the IRS for capital gains taxes he didn't see coming. He had one sale with multiple tax bombs. My name is Chris McClure, and for the past 30 years, I've watched smart, careful retirees get blindsided by this exact problem. Selling depreciated assets in retirement doesn't just trigger capital gains tax, it sets off a chain reaction. Medicare penalties, higher tax brackets, and surprise IRS bills that hit months later. Alan and Teresa came to us after this happened. They were thinking about selling another property and wanted to simplify their financial life before retirement. You see, they also had a $2.1 million brokerage account, and much of it was legacy stock that they'd held for years. Some positions had doubled or tripled in value. Their previous advisor had told them, "Don't worry about it, just hold everything until you need the money." But they really needed to start diversifying, and now they were stuck. You see, every sale would trigger huge capital gains. The rental income had already pushed them into higher tax brackets, and they were approaching the thresholds where Medicare surcharges and Social Security taxation kick in. So we mapped out a 5-year window where they could harvest about $90,000 in gains annually while still keeping under the tax thresholds. You see, that gave them some breathing room. And for the second property sale, we actually paired it with a $60,000 gift to a donor-advised fund. And that charitable deduction helped offset the gain, and it supported the charities and the causes that they cared so much about. But the biggest dilemma for them was these 5 inherited stock positions. It was worth around $900,000 with only $200,000 of basis. They had been holding them for a long time. They'd been debating whether to sell and reinvest, but when we asked, "What's the purpose of this money? What are you trying to accomplish?" They said, "We want to leave it to our kids someday." And so the answer became clear. We just left it alone. You see, by holding these positions until death, their kids would receive a full step up in basis. All of those gains would disappear for tax purposes. The $670,000 or $700,000 or so, that gain, it would be gone. Alan and Teresa avoided more than $250,000 in unnecessary taxes for their children, and it didn't change their investment strategy or take on additional risk at all. You see, most people don't realize how much coordination matters until they see the numbers. And that's exactly what Brian and Leah discovered when they came to us. They had about $3.9 million in assets, including concentrated stock. And this was stock that they had inherited. And it had massive gains, low basis, and they were unsure what to do. They had held that stock for a long time. They wanted to diversify, but they didn't want the tax hit. So we asked the question again, is this money meant to fund your lifestyle or your legacy? When they said legacy, well, we repositioned those assets into a trust structure, and the gains will step up tax-free when their kids inherit them. So there's no need to sell now. No need to trigger taxes just for the sake of diversification. You see, once required minimum distributions start for you, once Social Security kicks in, and once the gains hit your tax return, managing the damage from that tax becomes much harder. If you're within 5 years of retirement and you're sitting on appreciated assets, whether it's real estate, a business, or inherited stock or some kind of stock you own, this is really your window to get ahead of it. If you'd like to explore what this could look like for your situation, there's a link below to schedule a call. I think you'll walk away with some insight based on your specific positions and timeline. I really love making these videos, and if this helped you think differently, I hope you'll join me for the next one.